They want the stock market to go down. They want home prices to go down. Why? Because there's not a snowball's chance in hell they're going to get to their 2% holy grail consumer inflation without there being a period now of asset deflation. It is 100% necessary. The recession, in their view, the aggregate supply curve is sclerotic. They're not paying attention to the supply curve. We have never seen the Fed tighten policy into such a bear market. I mean, the CRB raw industrials are down 20%. Who has ever tightened policy? I don't think Volcker tightened policy into a bear market in commodities to this extent. They don't care. And they're telling us in their forecasts that we're going to have a recession. In a liquidity-induced correction, about 40% of the previous bull market gets unwound. And by the way, that was just as much true, because don't forget that the awful October 1987 happened after a huge 5-year bull market in equities off the August 82 lows. You have to take a look at how much are you reversing? Okay, how parabolic was the move before this bear market? You can't just say, oh, we're in a bear market. Historically, we're down 25%. We're down 25%. Go by the market. No. What is the reversal from the previous bull market condition? So if it is not a recession and it's just a liquidity event, like, for example, the fourth quarter of 2018, you reverse 40% historically of the previous bull market condition. When it's a recessionary bear market, totally different set of circumstances. In a recessionary bear market, 83.5%, just to be precise, 83.5% of the previous bull market condition gets reversed. That's why I was saying all along, I was saying it actually up until, the summer when we had that nice, 2-month rally off the lows. I said, look, if you believe this is going to be a soft landing, and a lot of people do, and this is just basically a liquidity event, the Fed's tightening policy, nothing else to worry about as far as the economy is concerned. And we're talking about, in that scenario, if you believe that, and you believe that therefore 40% of the previous bull market gets reversed, well, guess what? 36.60 was the low. And I said, if you believe that, the lows have been turned in. That's not what I believe, but if that's what you believe, you want to buy the market. Great. But I was saying that basically, if this is a recessionary bear market, which I continue to believe it is, and we look at historically what gets reversed from the previous bull market condition, which you always have to look at, to know where you're going, you got to know where you've been. Then you're looking at something that is more like 2,700 on the S&P. It's not 3,600 and change. And I think that's where we're heading.
Do recessionary bear markets always create liquidity problems?
Generally, you get liquidity problems along the way because it's all part and parcel of the fact that the Fed has drained liquidity so much that it's now impairing economic activity.
David, I want to ask you, so you've seen this, right? From the first day you walked onto the floor in 87, you've seen all of the crashes. The Fed is telling us that they want inflation down. They're telling us that they're willing to push us into recession to get there, and that they're willing to see the equity market go down. Do they think they can do this without causing a liquidity problem?
Well,
is that what they're inherently betting on?
Well, to me, it's a natural outcome. I said before, recession or not, we've never gone through a Fed rate hiking cycle without some sort of accident happening along the way. Whether or not you get a recession just makes matters worse because you get a default cycle on top of that. Inevitably, they're going to cut rates. It might not be. So
they're going to pivot anyway. Well, the question is, do they do enough damage to get there that they screw us for 2 years, basically?
Well, that's the cycle. But I mean, the thing is that, okay, look, with all deference, he compares himself to Paul Volcker. What more do you want? And of course, back then we had an emerging market crisis, and maybe you're looking at emerging markets right now, and you're looking, the busiest people on earth outside of the Bank of England is the IMF and the World Bank. And of course, part of this is also, you can look at cracks everywhere. The US dollar has only gone up this much this past year, only 5 other times back in the past 50 years. And we came off so much leverage. Like I said, this is like, the Fed was Lucy. The rest of us were Charlie Brown. They sucked us in. You see, this is where it becomes a very disingenuous that here you had the Fed, they opened up the kimono and were allowing, they were buying the capital structure of zombie companies, right? And then they're buying mortgages into the opening months of this year in the context of, we all know it was actually a bigger price bubble in residential real estate than it was back when I was pounding my fist on the table at Merrill back in the mid 2000s. The Fed's doing all this. They knew people were saying FOMO. They knew people were saying TINA. They knew people were saying the Fed has your back at all times. They knew that the Fed has your back. The Fed has your back again today, but they have a knife in it and they're twisting it hard. It's really quite, I'd say almost cruel that at no point did they use their verbal guidance to get people to, even Greenspan tried that. Of course, didn't work out so well for him in December of 96 when he talked about irrational exuberance. But you see, the Fed wanted the stock market. The Fed wanted to reflate asset prices for a while. And then we got more than we bargained for. They wanted to reflate. And then basically they just like a clown at the circus blew the balloon. And now the balloon is, I'm not saying it's bursting, but there's certainly helium coming out now of the real estate market. And you're seeing basically, look, it's been a horrible year, both for, pretty well for virtually every asset class. And so the Fed, but that's what the Fed
now. Is it different from 87 in that we haven't seen this absolute puke one day disaster, or in the case of 2008, 2009 great financial crisis, it was a week where we felt like we were in free fall and we did so much damage. This has been kind of this really painful decline all year, and you've seen big losses in some places. Is it orderly enough this time around to avoid falling into the crash history books, or are we're just going there? It just depends on where it happens.
Well, I think that if we get a situation, and the Bank of England, that's the boilerplate. Look, if we get in a situation where markets become dislocated, and you get some sort of calamity, the central bank has to step in at all times as the lender of last resort. And so, the Fed's not going to sit back and allow, they're not going to allow a Great Depression to unfold. And so, of course, they'll step in. That hasn't happened yet. Spreads have widened. The stock market's in a bear market. Treasuries have been in the bear market. Mortgages are in a bear market. I mean, pretty well everything. Commodities are now in a bear market. And you're right. It's always orderly until it becomes disorderly, and we can pick maybe 5 or 6 different things, I don't know, in the next year. The point I'm making is that, it's been orderly so far. They want the stock market to go down. I mean, how could you dispute that? Anybody can dispute that. Neil Kashkari comes on a couple of months ago and says that we were at the Fed, we were very disappointed at the stock market rallying in the summer because Jay Powell utters the words data dependency. No, we were disappointed that the markets rallied. And then, of course, after Jackson Hole, when the markets reversed course, he says, we're very actually happy with this response. They want the stock market to go down. They want home prices to go down. Why? Because there's not a snowball's chance in hell they're going to get to their 2% holy grail consumer inflation without there being a period now of asset deflation. It is 100% necessary. The recession, in their view, the aggregate supply curve is sclerotic. They're not paying attention to the supply curve. We have never seen the Fed tighten policy into such a bear market. I mean, the CRB raw industrials are down 20%. Who has ever tightened policy? I don't think Volcker tightened policy into a bear market in commodities to this extent. They don't care. And so, and they're telling us in their forecasts that we're going to have a recession.
So does this feel like it's going to be, if we get some sort of event that feels more like, 87, or, that we get that capitulation that everyone talks about, where everyone's just, because of margin calls, having to sell everything. We've kind of been programmed that from liquidity-driven events, things bounce back. Do we need to layer on those other factors you talk about and prepare ourselves for the fact that once it goes down and the Fed achieves the recession and achieves the stock market decline, that it could stay there for a while because of the damage that's been inflicted? Which sort of camp do you fall into?
Well, look, I think every cycle is different, but there's patterns that reemerge. We did get hit with several supply side shocks. I would have thought by now that they would have subsided. I didn't think that the core inflation rate was going to be heading up towards 7%. I'm astounded that that's happening. And then again, when you're taking a look at some of the sectors that are responsible for the inflation, it's been rents, OER and rents. That's 30% of the index. Medical care services, education. I don't know what the Fed can do about education services, which are accelerating. That was a huge part of the CPI. You have the rents, which are not going to subside till post first quarter, given the lags and how the index is constructed in the CPI. I think the Fed is overreacting, but they, as I said before, their principal concern came out in the minutes is that if they don't move really aggressively, that that it's gonna feed into wages. That's what their principal concern is. As a central banker, how do you get around that? Is you have to create the conditions for labor market slack to reemerge, which means a rising unemployment rate. What the stock market does, the stock market does. Of course, they don't mind. The asset deflation will actually hasten the day that we get to the 2% holy grail. We're not going to get a 2%. Inflation with the stock market going up to record highs, and home prices have to come down as well, and that's part and parcel. Home prices have to come down for the rents to follow with a lag to get to the 2%. It all falls out of basically asset deflation. Well, it's the asset deflation that can create the conditions for some sort of financial spasm. Okay, because what happens is that the bank's collateral, their biggest asset is mortgages on their balance sheets. What happens if we go into a default cycle? Home prices go down. The banks are already starting to tighten their credit scoring. So you get not only a run up in the cost of capital, but you also get a diminishment in the availability of capital. And that's what triggers the onset of a default wave, which we haven't seen yet. To me, that probably is next year's story.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.